the market reeling, global currency markets reeling from that hot CPI yesterday. Can Japan get these moves under control without more sustained intervention, without a type of G2 intervention? Your thoughts this morning, Mark?
They'll definitely have to intervene if they want to do something, because it's going down, and the numbers don't look very good. And I think what people are missing is that these inflation numbers are erroneous. You know, we look at the CPI, but that doesn't tell the whole story. What we should be looking at is money supply. As you know, in the last 2 years, money supply has gone through the roof in all these countries, and a 30% increase in money supply means a 30% depreciation of the currency, and that means more and more inflation. So I think the CPI is kind of an erroneous measure, but it's good enough for now. But I think it is going to be going higher going forward. And of course, the Bank of Japan can't control that. And the psychology of the market is going to be driving the yen in a lower and lower position against the US dollar.
Mark, good morning. Good to have you with us. So,
good morning.
Your expectation then is a more forceful G intervention, whether that's G2, and what? Stepping back from yield curve control?
There's no question that the Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believe the way to kill inflation. So you have 8% CPI. That means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
Wait, hang on, Mark. 9% interest rates? Is that where you see the peak?
Yes. If the inflation is 8, the Fed has to raise the interest rates higher than inflation in order to kill inflation. That's their belief, and that's the game plan.
So you're making a call this morning of 9% rates by the Federal Reserve of the United States of America, what, with more aggressive quantitative tightening? And what kind of an unemployment rate would 9% rates deliver for the United States?
Well, you know, the good news in America is, first of all, you've got a strong dollar, which means Americans are going to be able to import things much cheaper than previously. That's number one. And number two, you have a situation where Americans have lots of cash, because their incomes from overseas are getting better and better. And my recent visit to the U.S. indicates that things are going very well for Americans. They're spending like crazy. So I don't see, and of course, very big shortage of workers. If you go into any restaurant or any shop in New York or anywhere else in America, you'll find that they're looking for workers. So,
Mark, do you have a number in mind? Do you have a number in mind of what that actual unemployment rate would look like?
I think the unemployment rate is going to be much, much lower than, let's say, 5%. It depends on how you're measuring it, but that's my feeling.
Okay, so it's going to take a lot to take this money supply down. Can we just consider how they do that? The question I asked you was, do you see 9% rates in the United States of America and a more aggressive QT? Is the way to reduce, in part, this money supply, is it through a more aggressive quantitative tightening in the United States of America to impact FCON?
Yes, but one of the things you have to remember, and which is overlooked, and that is cryptocurrencies. I think the Fed and people in the policy-making level are not paying attention to the cryptocurrencies, which results in trillions of dollars of turnover. If you look at the cryptocurrency exchanges and how cryptocurrency is being created, this is a very big factor. Of course, not as big as money supply is measured in the US, but cryptocurrencies are huge. And they're having a wealth effect on many, many people, not only in the United States, but in the world. Many people are holding these cryptocurrencies and feeling wealthy. And that's another point that is being overlooked by policymakers, I believe.
Well, yesterday, getting that CPI number, that sent Bitcoin lower by nearly 10%, Mark, and that's only with the market pricing in a peak at just above 4%. What will happen to Bitcoin and the rest of risk markets if these money markets, if bets start to coalesce around, as you see, 9% as the peak in Fed rates?
Well, that's a very good point. And now we're in a situation where there are so many people with cryptocurrencies, and it's a leading indicator. When they lose confidence, in other words, when they see the CPI rate moving up and they feel that, oh, the Fed is going to tighten, they lose confidence, and therefore they begin to sell their Bitcoin and their cryptocurrencies. So I believe that the cryptocurrencies, particularly Bitcoin, is a leading indicator to what is going to happen in the stock market.
Okay, well, let's just push that a little bit further, Mark. Let's just extrapolate what you've given to Danny and I. The risk is 9% rates. The risk is tighter QT. To me, and to Danny and anybody else tuning in this morning, that may well imply a much bigger ransacking of equity markets than what we saw yesterday or year to date, down 5% yesterday. How much more wealth demolition will come in equities if the trajectory that you've just put forward comes to play?
You must remember, we've already come down quite a lot. You know, we are in a bear market. No question about that. So I'm looking at maybe another 10, 15% before people wake up to the reality that there are some great companies out there that are beating inflation. In other words, are able to price their goods higher than inflation rate. And these are going to be very good opportunities for investors. So we're probably, when we look at the index, maybe another 10, 15% down, but then there's going to be an opportunity to be buying.
So, Mark, that's the picture of American risk assets, but inflation rate hikes from the Fed is also hitting the most vulnerable. It's hitting emerging markets as well. What happens to your EM trades, to EM risk in this environment?
Well, if you look at EM currencies, almost without exception, they've all come down pretty substantially against the US dollar, just like the euro has come down. Now, what that means is that for some of these countries that are export-oriented, they're going to be in a much better position to export to the U.S. So we have to pay attention to those companies. And then, of course, there are companies in these emerging markets that are doing very well domestically. In other words, they are exporting their software or their products and are spending locally in depreciated currencies. So we have to look for those companies that will be doing well. But if you look at the indices, of course, emerging markets index has been battered mainly because of China. China's down substantially. But at the end of the day, I think you're going to see some of these opportunities in emerging markets arising. And of course, there are some countries like Indonesia that are exporting a lot of palm oil and other commodities that are doing fairly well.
Mark, you've mentioned China there. Let's just get your thoughts as we go to the close here. We've got a zero-COVID policy. People are talking about a 2% growth level, and we have intervention on the yuan with the risk of more sanctions over Taiwan. It's a fairly bleak outlook. Lots of people have said to Danny and I they can live without China risk with that hit parade of risk on it. How folly would it be to live without China in my portfolio, or how bearish are you on your outlook for China?
I think it's probably a good idea to have very low weight in China at this stage of the game because of the reason that you just mentioned. There's lots of things hitting that market. The COVID, the crackdown, the election coming up, and so forth and so on. So I would say that, yes, probably to have a low weighting, but start looking for bargains in China, companies that are, as I mentioned, having pricing power, and there'll be some opportunities there. But generally speaking, our bet is more on India, on Taiwan, and other countries.
Mark, are you concerned about, in terms of what it does to China risk, the upcoming meeting, or at least the potential meeting between Xi and Putin?
That's a very good point. As you noticed that Xi has had a conversation with Biden before, this meeting. So I think the Chinese would like to play both sides, would like to keep the U.S. stable so that exports can continue and trade can continue. But at the same time, there's no question that they are favorable to what Putin is doing. So it's a tightrope they're riding, and it'll be interesting to see how that develops.